because this chart just above it, this is PUT. What this index does is it's the S&P 500 as well. But what it is, instead of buying those 500 stocks or what have you, you're selling an option against it, specifically a put, which is a bullish trade, because what you're basically doing is you're selling the right to someone else to sell you the stock or the index in the future. But in this case, what you've done is when you sell options, what you're really trying to do is you're taking some risk out of the market, and you're being compensated to do that. Well, when you sell an option, you actually don't have to be right on the ultimate direction that the market is going to go. The market could stay flat, it could kind of go against you a little bit, or it could go the direction you forecasted and you wind up profitable. You only lose when the market moves a lot against you. So it's one of these things that while you certainly will have losing periods, such as this one did in 2001, 2002, the difference is dramatic. In an unleveraged these are two unleveraged portfolios. The put portfolio has increased in value by 100% over that same 10-year period. So 0% down here, same asset class, the S&P 500 in both cases, but in one you're selling puts against the S&P 500, in the other one you're buying the S&P 500 itself. So I wanted to just kind of mix it up a little bit to show how this works in other capital markets, because I find that oftentimes traders are not aware that the capital markets they all pretty much look the same way. If a strategy works in one capital market, typically it's going to work in another capital market as well. Okay, hang on. I'm going to bring up a series of currency, and I'm going to share with you a strategy that I play myself. And I'll explain this in as much detail as I can, and I'll show you how to get some more information if you'd like some. So here we're looking at the dollar yen, and I just saw analysis that I totally agree with. We're looking at this uptrend, but as much as I would like to be bullish on the dollar yen, I'm having a hard time with it because we're stuck at 108. We just cannot seem to break through this level. And as attractive as it seems that there might be some opportunity here, it just really seems like it is unlikely that in the short term the dollar yen is going to be able to break up above 108, even 108.50. It seems just really unlikely, because that resistance level is so significant. We've been stuck here for going on a month now. So it's interesting that. Hey, thanks, CVJ. So, what do we do here? Do we go long the dollar yen? Do we go short? I mean, it's. I don't think going short is a bad idea. It's just that we've got this long-term, or we've got this intermediate-term trend here that we'd be kind of fighting. So I look at it from the perspective of, well, it's a weak trend, so it may be better to just go elsewhere to find long and short trades. But what we could do is sell an option, because what we do there is, so for example, I've got a line just drawn right across your resistance. One of the things I look for is I look for the trend, and then I sell an option that's against that, or that's in cooperation with that trend, if you will. So in other words, in this case, I would be selling a call because that's a somewhat bearish thing to do. What I'm hoping is that the market does not go beyond 108. When you sell a call, you get paid a premium up front. In this case, by the way, if you're selling a call with about a month left before expiration, you're going to get about 100 pips worth of value. You're going to get paid about 100 pips worth of value, which puts my break even up around here. So as long as the market doesn't go beyond 109 in the short term, I'm in the money. And it's the same idea as meaning I'm in the money as in I'm making some profits. It's the same idea as that's being used by traders in the S&P, where they're selling puts against the S&P because ultimately they're trying to take advantage of the uptrend on the S&P, but they don't want to have to to sustain all that market exposure, so they're diversifying their trading by pushing into a different asset class or instrument class. So they're and in this case, I'm looking at the Forex as my asset class, but I'm using another instrument class to diversify out some of my risk, and that being options in this case. So I could go down the list here. Let me snag another one. By the way, this list that you're looking at right now, this is my list of currency pairs that I sell puts or calls depending on the trend against every month. So just depending on what it is. Let me show you one more example. I think that is, we'll make a we'll do the euro. This is a good one. Okay, so the euro is a good example. Right now I'm overall, although the euro's been consolidating, it's a little bit different forex champion. It's very similar to the covered call strategy, but in this case I'm just selling the option itself. I'm not holding the underlying spot position long or short to offset it. But it's very similar concept here. So in this case, with the euro, what I'm trying to do is to determine where is the euro likely to not go. If I'm moderately bullish, in other words, I think that the euro is probably going to go back up to resistance here. Whether it goes beyond resistance or not, that's a good question. But overall, the prevailing trend is still positive. And one of the ways in which I define the trend is I'll look at the COT report. So I'll look at where institutional investors are balanced in the futures market. So if they're net long overall on the euro, then I'll kind of stay net long myself in this particular trade. And in this case, so if I'm a little bit bullish, that means that I'm selling puts. Because once again, I'm accumulating. Now in this one, the premium's a little bit better. So if I'm selling a put at 56.50, I've got 150 pips to the downside worth of value that I'm being paid to take that risk. So the market could fall down here, and that's about where my break even is. So I'm building in a little bit of margin because what I know is that the market is going to be volatile. I know that one of the ways I can take advantage of that volatility is by selling options that are outside the range of where the market is likely to go in the short term. So in fact, I would summarize one of the big benefits here of diversifying into different asset tools. So in this case, not only looking at the forex market as an asset class, but mixing in option strategies to try to develop diversification on a tools basis or an investment tools basis. Because one of the big benefits is, the question is, well, with a put or a call, you only have to be right once instead of twice. If you're selling a put or a call, if you're buying, then you have very similar. You have to be right in both time and distance. So in other words, you have to have the right direction as well. But when you are selling an option, when you are the option writer, you get paid the premium up front. What that means is the market could stay. So the euro could stay flat. It could go up, or it could even decline a little bit. And as long as it doesn't cross this line, I'm still going to be profitable. So so you're not sacrificing return at all. Here's what you are sacrificing. You're sacrificing volatility. It's the same reason why I contrasted that index that assumes that you're just selling or writing puts on the S&P 500 versus the S&P 500 itself. The returns, the trend of those returns looked similar in a lot of ways. The difference was the downturns were much less significant and the upturns were much more important. So the same concept works here, but it's the takeaway is it's not just a matter of diversifying across asset classes or even different assets within a class. So looking at multiple currency pairs and even multiple capital markets, but it's even a question of developing strategies that utilize different different investing instruments, so options and the outright spot position itself. Okay, so I'm going to pause here. I want to give you a couple of things. So if you find this interesting, you want to learn more about, how to, if you're unclear as to how to write an option, or why it is that you get paid up front when you sell an option rather than getting paid when the market moves, like you would in a long or short spot position. We have a number. I've actually done a couple of presentations here on FX Street that you can check out as well on that particular topic. But you can go see it on the site. We have a whole we have a whole section on, or a whole course on forex options, and I go into quite a bit of detail on selling options. So you can check that out, and it should give you plenty of information to be able to start paper trading this particular strategy, so you can get an idea as to how does this work and how can it ultimately, the big goal is to turn our equity curve into that real flat curve we saw on the counter asset, the S&P 500, and that is a nice smooth growth in total return.